What's up, everybody? It is a new month, and at the beginning of the last couple months, I shared with you a couple stocks that I thought were undervalued. We're going to do it again. I have two companies to share with you for this month. Now, I don't want to repeat myself too much. I'm sure a lot of you know that I am bullish on the healthcare sector. I just made a video on Elevance. You might know that I like Caspi and Evolution, and on my channel, you'll find my thesis on a bunch of companies that I think are deep value. But I want to share with you a couple new names. One is a company I own. The other is a company that is on my watch list. If you get value out of the video, subscribe to the channel. It is crazy to think that we passed 1,000 subscribers here. So I really appreciate everyone who has followed. Now let's dive into this video. The first company I want to share is Deckers. I like this company. I like their products. I don't yet own the stock. It's one I've been watching for a little bit now. And you may not be familiar with the name Deckers, but I bet you know their brands, UGG and Hoka. They own several other footwear brands, but these are definitely the big two. UGG makes up about half of their revenue, and Hoka, it's pretty close behind. About 45% of their revenue now is Hoka. I'm very much into running, and my previous pair of shoes were Hoka's. I ran them into the ground. I got great mileage out of them. These shoes have awesome padding. They really just feel good to wear. And UGG has been a surprisingly strong brand. I thought 5 to 10 years ago that UGGs would maybe be a fad, but you know, this brand has been incredibly resilient. We see this brand just hit about $5 billion in sales on the top line, and they're growing 16%, so double digits. And this growth has really been fueled primarily by Hoka. You'll see in my sheet, pulled in a bunch of fundamentals on the company, and look at revenue. It really just took off in 2020, and this is Hoka. Over this time period, Hoka's sales have more than 4x'd. And over this same time, they've actually been expanding margins. They've been becoming more profitable on the bottom line. They're now up to 23% operating margins, which for a shoe company, this is absolutely incredible. I mean, it's not like they're making semiconductors here. They're just putting together shoes. Anyone can do that. When you see operating margins increasing for a retail company like this, it tells me that the brand is getting stronger. They're able to have pricing power. They're able to increase their prices because of the brand. Now, this is the first video I'm doing on Decker, but I mentioned them in my Nike video. So just a comparison, I'm just going to put in Decker and Nike into my sheet. It's going to take a moment, but my sheet is going to populate a bunch of information on these two companies. In my Nike video, you can go back and watch it. I said, I don't see why I would invest in Nike when I could invest in Decker. Margins, absolutely blowing Nike out of the water. Growth, this company is growing much faster than Nike. You'd think that Decker would trade for a premium valuation, but they're not. They're only trading for 15 times operating earnings. Keep in mind, this is a company with no debt. They have a net cash position. Their balance sheet is absolutely pristine. So going through their slides here, after their overview, it's no surprise that the first slide is on Hoka. They have 5 products that are grossing over $100 million. I had the Cliftons. They were great. And here you see Hoka revenue just 4 years ago was $571 million. Now it's $2.2 billion. This is incredible growth, and I think the runway is really long here. We see 60% of sales are in the US, so only about a third international. I think we're going to see international growing faster. They say building blocks for future growth. Market share gains in unpenetrated geographies and categories. It wouldn't surprise me to see Hoka taking more international market share away from brands like Nike in the future. And UGG, while it hasn't been growing as fast as Hoka, still 13% growth on the top line. This has been a much stronger brand than I anticipated, and I think a lot of that was because I thought of UGG as just a shoe for primarily women, but they've really made a ton of headway marketing this to men, and they've had a ton of success there. As far as long-term goals, the management just speaks my language with what they say. Revenue growth with high caliber operating margins, no debt, healthy cash balance, and especially this right here. Lots of share buybacks. Right now, their authorization is more than 10% of the market cap. And on our sheet, we see shares, they've just been going down. I love to see a company like this buying back stock, especially when the valuation is not too demanding. We see that their stock price right now, it's dropped a lot from their high. They were down close to 50%, now down a little bit less. It popped on this earnings report. But I think the stock is still offering quite good value today. As far as what I'm modeling out for a return on this investment, in my base case, I'm looking at 12% revenue growth for the next 5 years. That's a little bit lower than they did in this quarter. I'm looking for operating margins to pull back just a little bit, and I'm only giving them a 15 times multiple, which is not demanding at all for a company with this kind of top line growth, no debt. And if these assumptions come true, you're looking at 16% annualized return on Deckers today over the next 5 years. That is more than a double on your money. My bear case with just 8% growth on the top line, margins pulling back to 20%, and only giving them a 11 times multiple, you're still looking at a 4% annualized return. This is a great result. I'd have to give them like an 8 times multiple before you'd be down on your money. And as far as the optimistic bull scenario, I'm assuming revenue growth stays at 14% for 5 years. Basically, the top line growth does not slow down. Operating margins don't retreat, and they command a 20 times multiple, which, by the way, is a lower multiple than what Nike is trading for now with lower growth. If this scenario comes true, you're looking at a 26% annualized return on this stock, so more than a triple over 5 years. Basically, I think the risk reward on Deckers looks really good. Again, I don't own the stock right now, but it's on my watch list. It's one that I'm thinking about adding to my portfolio. It's definitely a company I think is undervalued. If you're liking the video so far, shameless plug, subscribe to the channel. Now, let's get into the second stock. And the second stock I want to talk about is Lyft. If you live outside of North America, it's possible you might not be familiar with this company. Lyft does not have the global presence that Uber has, but Lyft is a ride-sharing app, very similar to Uber. They don't have an Uber Eats equivalent of food delivery, so it's not quite as diversified, and obviously their revenue is very concentrated in the US. But if any of you watched my Uber versus Lyft comparison video that I did a little bit ago, you know that I like both Uber and Lyft, but there's only one I own. I own Lyft, and I think the risk reward on this company is really good right now. They are a $6 billion company with over $900 million in reported free cash flow. Now, I adjust free cash flow for stock-based compensation. That's a real expense to us if we want to own equity in this company, and Lyft does give out a bunch of shares to its employees. It has been coming down. The new CEO has been tightening the belt here. And now they have a $500 million buyback program in place. So I am looking for this share number to stop increasing and likely decrease over the next few years. Regardless, even looking at my adjusted free cash flow number, they're trading for almost a 10% free cash flow yield. And this is a company that still has extremely strong growth. Gross bookings up 13%, rides up 16%. These are amazing numbers on the top line, and the bottom line actually looks even better because as revenue is increasing, they are improving their margins. We see this company just in the past year flipped over to being free cash flow positive. We see on our sheet trailing 12 months, operating income is still negative, but in the most recent quarters, it actually is flipping positive. They flipped into operating profitability within the past year. This is an asset-light business that is clearly going to benefit from scale, so as revenue continues to increase, I expect these margins to continue to get better. Right now, because the company is just flipping into profitability, I think the market is underestimating the earnings that this company is going to have in the future. Buying other asset-light companies as they flipped into profitability like Palantir or Uber is probably the best comparison. Those were great bets. If you bought Uber right as they were flipping into profitability in 2022, you did amazingly well. I think we could see a similar story in Lyft over the next 5 years as they post strong operating income. They report their Q2 earnings next week, so I'll definitely want to take a look at that, but they're guiding for 10 to 14% growth in gross bookings. They're also saying 2.7% adjusted EBITDA margins. I will definitely want to see them hit this number. If they outperform that, that will be excellent. This would be a new peak in margin here for them, which will be great to see. They're also expanding into Europe, buying up Free Now, which is a taxi hailing company. It's yet to be seen whether this is going to be value accretive to Lyft shareholders, but there's a huge market in Europe that Lyft is not taking a part in right now. I think Lyft is well positioned to compete here. And, at the end of this presentation, they say, consistent with Lyft's capital allocation strategy of investing in profitable growth and further supports targets of 15% compound annual growth rate to deliver $25 billion in gross bookings in 2027. Keep in mind, trailing 12 months, we're looking at, like $16.5 billion in gross bookings. If they're able to hit this number, which of course is not a guarantee, and continue improving margins, which I believe that they will, then Lyft stock is just looking really cheap today. I think part of that could be a lot of uncertainty about autonomous vehicles and what that means for the future. You have companies like Waymo and Tesla that are trying to play in this autonomous vehicle space. And frankly, I don't see autonomous vehicles as much of a threat for Lyft, more of an opportunity. As autonomous vehicles penetrate this ride-sharing market, you're going to have cost reductions. The biggest share of those gross bookings go to paying out drivers. If their costs drop, then I think that will be another tailwind for margins for Lyft. I'm not sure how quickly self-driving will take over. Lyft makes the case that you're probably not going to have an autonomous vehicles only market, because then the supply of autonomous vehicles would be roughly constant. And if that supply is high, you're going to have tons of periods of oversupply, low demand, and vice versa if that supply is low. So you kind of need this hybrid market so that supply can meet demand. Anyways, the future of autonomous vehicles is definitely a bit of an uncertainty here, but I don't view it as something that will definitely hurt Lyft. And for the valuation that Lyft is trading at today, you don't need a lot to go right for this to be a great investment. When I'm looking 5 years out, my bull case is essentially management's long-term guidance. So my base case is actually assuming they don't even meet the guidance that management is setting out. I'm assuming revenue growth slows to 10% a year. I'm assuming they reach 7% operating margins 5 years out. They're not going to reach this next year, but these numbers actually don't affect the final valuation in my model. I'm assuming a 5% free cash flow margin, which is lower than what it is right now. And I hope that most of this is coming back to us shareholders in the form of buybacks, which if we go by what management said on the last earnings call, then they are looking to deploy more capital into buybacks, rewarding shareholders. And I'm giving them just a 16 times multiple, which for a quality company like this with decent growth on the top line, I don't think this is that demanding at all. And if these assumptions come true, you're looking at about a 20% annualized return over 5 years. That's about 140% upside, certainly pretty good. My bear case, I have growth slowing immensely, 6% on the top line. Operating margins only reach 5%. By comparison, Uber right now is at 8.5%. So I'm saying 5 years from now, Lyft will still be nowhere close to touching Uber's efficiency today. And I'm giving them just a 12 times multiple. And if this case comes true, you're probably flat on your money, maybe down a little bit after 5 years. Obviously, this would be disappointing, but it's not too ugly of a scenario in my bear case. And my bull case, as I said, this is pretty much what management is guiding for. 14% on the top line, operating margins essentially hitting where Uber is now. So saying Lyft is roughly 5 years behind Uber, which if we look at their margins, Lyft has historically been, 3 to 4 years behind Uber on margins. So I think this is very reasonable. And I gave them a 20 times multiple. I think if they're actually hitting these growth numbers, that's not unrealistic at all. And if this scenario comes true, you're looking at a 36% annualized return on this stock. This would have Lyft stock hitting close to $70 a share in 5 years. So overall, I think the risk reward looks really good. There's a ton of upside if we're right about Lyft, and I don't think the downside is too ugly if we're wrong. If you're watching the video in the future and the price is significantly different from today, you can see if our assumptions in our base case come true. These are the different annualized returns I would expect over 5 years at different prices. So if Lyft stock drops to, $12 a share, you're looking at 24% annualized returns in our base case. And obviously, as the price goes up, the risk reward becomes less attractive, but we might have to reassess as earnings come in. And that's all I have for this video today. If you got value out of the video, subscribe to the channel. It is crazy to say that we have over 1,000 subscribers here right now. That was not the case a week ago. So thank you to everyone who's found my channel, who's followed along. If you agree or disagree with anything I said here, leave that in a comment down below, and I hope to see you in another video.